good afternoon, ladies and gentlemen. Great pleasure to be here in London, catching up with people that I've known in the past, getting around a few of the resource funds, finding out what the view is on metals and that sort of thing. But let me introduce you first to DART. It's a very small company, would be probably one of the smallest market caps here today, at around $7 million. The strength of DART is that we have a very large land package. We're very focused in the area, regional area. We have no other interests outside of the regional area. And we are polymetallic. We have a fairly large number of different metals, including lithium, gold, copper. We have the 6th largest molybdenum deposit in the world, contained molybdenum, called Mount Unicorn. That's probably historically been the company's flagship project. The moly price fell 90% between 2010 and 2015. 2015, it was the worst performing commodity in the world. And so on that basis, we did shelve that project. But 2 years later, we discovered the first lithium pegmatites, hard rock lithium, on the east coast of Australia. And we have been very busy further exploring. It's referred to as a pegmatite dike swarm in geological terms, and we reckon there's in excess of 2,500 of these pegmatites within the area that we're looking at, and I'll get to that too. Forward-looking statement, you all know about those. They're our metrics. We have got a very, very good shareholder base, register, a number of substantial investors holding our stock who we've managed to convince that we have a very good story to tell. The exploration profile, as I briefly mentioned, the Mount Unicorn molybdenum deposit discovery back in 2008, very significant, geologically redefined the entire area that we're focused in. And there was a lot of development work went into that. It's actually got a resource on it, a declared JORC resource, around 110 million tonnes of ore at a grade of around 0.06. It is a porphyry structure, and I'm not sure how many of you are familiar with porphyry structures, but porphyries, in my book anyway, are the desirable deposit. They tend to be very low grade, but huge tonnes. And I'd prefer huge tonnes and low grade over a high grade, small tonne type deposit. So Mount Unicorn was suspended in 2015 as a result of the 90% decline in price of molybdenum over about a 5-year period. Reason for that, interestingly, was that the Chinese became net exporters of molybdenum. Prior to that, they'd been very significant importers. And for those that don't know the metal, it's an interesting metal, used in high heat applications for strengthening steel, and also used in fertiliser and grease and all sorts of other applications. There is actually an LME contract on molybdenum, but I think it trades by appointment. In 2016, we discovered the first hard rock lithium deposits on the east coast of Australia. Western Australia is better known for hard rock lithium. In fact, it's probably a global hotspot, or if not a leader in hard rock lithium, with the Mount Holland project owned by Kidman Resources and the Pilgangoora project owned by Pilbara Minerals, which from discovery to production took 4 years, which was actually a great result by them. They are now exporting lithium concentrate at about 6%. They have enormous quantities of tantalum as a credit with that. And anyway, I'm not here to sing the praises of Pilbara, but it was a very, very good project, well executed, great company. We are concurrently moving our lithium strategy and our gold exploration activities forward together. We don't want to be a one-trick pony. We don't want the lithium price to collapse or the gold price and be left with, nothing to talk about. But as it turns out, lithium is a very hot commodity. It's been under pressure for the last 12 months, but I think lithium continues to look like a very constructive metal into the future, for perhaps the next 10 years. The long-term forecasting on the lithium prices, in my view, and that is from quite a deal of research, are massively underestimating the demand. And therefore, I think at the moment we're producing around 300,000 tonnes of lithium carbonate annually, globally. The 10-year forward forecasts are at about 1.5 million tonnes per annum. We think that that is really substantially underestimating the sort of demand that is going to materialise as a result of global electrification and batteries, therefore. People talk about lithium and competing chemistries such as vanadium, and even molybdenum, funnily enough, is getting a mention in the battery chemistries as a thermal stabiliser. The market is highly dependent on cobalt. Cobalt is a precarious supply commodity, most of which comes out of the DRC. Most of that is controlled by Glencore. But other thermal stabilisers have other metals acting as thermal stabilisers within batteries do have quite a significant upside, and there are different metals such as moly and vanadium. Excuse me. So, 2016, discovered the lithium pegmatites. We've been very busy searching or exploring both through aerial surveys, ground truthing, and about 2 weeks ago we started drilling the first of the pegmatites. Has taken us a while to get there. Took us a while to get the money in the bank, clean breeze, no company issues, that sort of thing. That's where we're at now. The project locations is in the state of Victoria in Australia. Bottom left-hand corner is the Victorian map. We are up in the northeast, or in the top right corner, if you want to call it that. It's what we describe as tiger country. It's very rugged, a lot of it, and there's one or two aerial shots that I'll be able to show you indicating that. We have around about, I think in the presentation it says about 2,500 square kilometres of ground there. It's probably a bit closer to somewhere around 3,000 square kilometres of ground. So, heck of a lot of ground. Highly mineralised area of Victoria, and I'll get on to Victoria too in a minute, as long as they don't cut me off time. Yeah, 2.5, that's probably more like 3,000 square kilometres. These are what we loosely describe as the projects. You'll see top left corner, the lithium strategy, Dorchap North and South. I've got pictures of both of those. Porphyry projects, which I guess are but these are all company maker projects, each one of these on their own as a company maker. The porphyry projects are just a scale beyond. The biggest gold mine in Australia is a porphyry project at Orange in New South Wales, operated by Newcrest. It produces around 1.2 million ounces of gold per annum. Very, very low grade. They're actually producing at less than a gram a tonne from that mine, Cadia East and Cadia West. So what that demonstrates is you can make good money out of really low grade stuff if you've got the tonnes. And that's what porphyry projects are all about. Massive tonnes, low grade material. And if you're really lucky, you get high grade. Like Sol Gold, which may be known to some of you, listed on AIM. They released supposedly the best ever drilling results ever released anywhere in the world about 2 years ago from their porphyry deposits down in Ecuador. Fabulous story. So, lode-style gold projects, top right, Buckland, Sandy Creek, Empress, Rushworth, Mountain View and Onslow Reefs. The porphyry projects, you'll see Mount Unicorn there, that's the big molybdenum deposit. Mount Morgan is a silver-dominated porphyry. Copper quarry, well, that sort of says it all. It is a pure copper porphyry. Stacey's and Empress, these are actually in our preferred priority as well. Stacey's and Empress are gold copper porphyries. This is just the squiggly lines are aerial survey lines from helicopters hunting pegmatites. So you have to visualise the outcrops. You don't know how big they are really until you put a drill into them, but they do outcrop, and sadly they grow terrible moss and blend in really well with the ground. So they're hard to spot, but if you can find a pegmatite that's got 2 or 3 million tonnes potential and it's carrying a grade up around 1% lithium, lithium oxide, then you've got a, if you can put that together with another 5 or 6 the same size and declare a resource of 10 million tonnes at 1%, you've got a project. So that's the sort of scale. We have around 2,000 of these dikes that we've identified so far. There's a lot of them that are very small and won't make the economic grade, but there are plenty of them that we think, with more drilling, we will be able to get them into a resource. That's Dorchap South. This as I said, in the mountainous area, those sort of baldy, greeny area down in the bottom left corner, that's Mount Bogong. That's at about 6,500 feet. So we do operate at around 1,000 metres, 3,500 feet in altitude. It gets bloody cold in the winter. It gets hideously hot in the summer, and it is crawling with snakes. So it's an interesting area, but very, very mineral rich. This is a Buckland Gold project, probably our most favoured gold, or our highest priority gold project at the moment. About 12 months ago, we decided to only prioritise projects that would offer up real scale potential. Across all of our ground, we have approximately 900 old gold workings from previous gold rush days back in 1880, 1890, 1910. There was a lot of tin mining up here as well. But the Buckland Gold project, we've only done geochemical work. In fact, no, that's not true. In Fairleys, we have done some drilling, and there's a small resource on that, but we're doing a much more region-wide approach at the moment. We have got some fantastic arsenic anomalies, which are they're the signature. That's what you're looking for. And we've done sort of 1,200 metres by 1,200 metre soil sample grids, and they've come back absolutely stinking of arsenic. So we think, and based on the host rock and the country rock, this project appears at this stage to offer up really significant potential. So we're pursuing that as a priority. That's the Buckland Gold. The Buckland River runs down the middle of one of those valleys that you can see. The Buckland River, for literally 150 years, has been a very significant source of alluvial gold, and we think that all of that alluvial gold is coming out of this shear structure that we've got pegged and that we've sampled over the last 6 months or so. So our exposures are to lithium, tantalum, tin, moly, copper, zinc, gold, and silver. A bull market in something makes up for a multitude of sins, as we all know. So the idea is that you've got to, it's great to be in a commodity or commodity exposure, which is very constructive. We found out the hard way with moly. But so we do keep not just a weather eye, we do some pretty heavy-duty research into our exposures, our implied exposures. And lithium is fabulous in our view, vastly underestimated in terms of demand uptake over time. Tantalum is really just a credit, it's a byproduct of the lithium mining. Tantalum has got a very positive outlook too, but unfortunately, because of all the lithium mining, there's likely to be an oversupply in tantalum, and we think that the price will come under pressure. That Pilgangoora project up in the Pilbara, which I mentioned earlier, run by Pilbara Minerals, they'll produce probably about 15% of the world's tantalum requirements. So that's just come on stream, and I'd expect that from other lithium projects going forward. Moly is very abundant. It's a byproduct mostly of copper mining, and producers have very little control over the price of it, and because it's marginal, people will sell it for whatever, and to credit, people will sell it for whatever they can get. So I would expect, it has recovered substantially from 2015, but to go another substantial leg up in moly would be probably unlikely. Copper is very different. Copper goes into supply deficit probably within 18 months. There's been really interesting trend in exploration over the last 10 years since the GFC. The first thing that was cut after the GFC and mining were exploration budgets. So there's been no exploration, I mean virtually none, for the last 10, 12 years, well, since the GFC, 11 years, by the majors. So the majors' exploration profiles are all massively shrunk, and as a result, there's been no development work either. So I think this does apply not only to precious metals, but others, to base metals, but others as well, that we're going to see some real supply deficit. So a lot of price action in metals, in base metals over the next couple of years, few years, will be very much the supply constraints on those metals. So copper, you've got a lot of very big, Escondida in Chile, owned by BHP, coming to end of life. They're pulling copper out of there 1.6 kilometres below surface. Or, it's costing a heck of a lot of money. The deeper they go, if they're not getting richer grade, it's cost them less margin for them. It's probably within 2, 3, 4 years of end of life. It produces around 8% of the world's copper. So, and there's other projects in a very similar basket. So the exploration profiles and some of the constraints that have been created will lead to supply-driven higher prices for a number of different metals. The gold price, well, who knows? But in Australian dollars, fantastic. Absolutely historic highs at present because of the low Australian dollar. Gold bullion's trading at around 1800, 1850. Cost of sustained extraction or sustainable extraction is probably running at around $800 to $900 an ounce. So the margin there you can see is fantastic. So Australian gold miners are having a fantastic time in business at the moment. And that's caused a huge revival in interest in Australia, and particularly in Victoria, which has, over history, Victorian gold or extracted gold has accounted for around 2 to 3% of all gold ever mined anywhere. So Victoria is off the radar for a lot of people, but it is enjoying a significant renaissance. You've got majors coming in there who have never pegged, like Newmont, for example, in Victoria. And Dart is sitting in a fabulous position with significant footprint. And we've got Newmont pegged right up to our boundaries on a couple of the projects. And our business, the Explorer, is probably not to take these things all the way through to production. We would joint venture that out in, farm out operations. And so people would earn more equity in these ventures as they spend more money, as they become more successful. Dart takes less, but it's taking less of a bigger pie. That's our kind of business model. Sorry, all over. Oh, forgive me. Oh, right. Okay. Sorry about that. I do get a bit carried away. So, look, in real summary, we're a junior explorer with demonstrable experience. We're geographically focused in Victoria. We have a commanding tenement position. The leverage in our valuation is enormous. I mean, if you buy our stock, you're not looking to make 50% on your investment. You're looking to make 500, 1,000, 10,000. Who knows? But it's one of those, right? So it's a real punt, but it offers enormous leverage. Victorian gold interest is massive at the moment. Never been in contemporary times higher. We spoke about farm-in deals. We have a very efficient commercial and a very, very good technical team, and we have a very good register. Thank you very much. Good on you. Thank you.
Wait one. Oh. Did anyone have any questions for James, please? No. James, I'll ask you one quick question about the lithium side. And electric vehicles and how you think that's going to progress going forward and how much that could generate for your company.
Well, yeah, we kind of touched on that, but the forward demand forecast by some of the professional forecasting outfits like Roskill and whatever, we think are significantly below where it will eventuate. That is, tonnage demand. And you can understand some of these forecasting houses have got a real problem in being terribly realistic with 10-year forward forecasts, because for them it represents a massive business risk. If they're going to come out and say, well, actually, lithium demand is going to be 20 times what we thought it would be 2 years ago, kind of makes them look a bit silly. So there's a bit of professional timidity, I suppose you could call it. We think, based on hard numbers that we've looked at, that as the world electrifies through vehicles, grid storage management, lithium demand is going to be much bigger. And competition from other chemistries for batteries is not going to be an issue for the next 20 years, because it's actually all about the supply chain. And once they're established, as they are through lithium chemistries, they're there to stay for a good 15 or 20 years. Thank you very much.